Hello and a warm welcome. You've joined us here on Buy Now, Sell Now, right here on ET Now. I'm Ashesha Advaryu. With me is Kavita Thaplyal. And clearly, we have seen a lot of action within Indian equity markets, and we are bleeding today as well. Nifty is sitting with a cut of more than 1% in trade today. In fact, if we take a look at the indices, Nifty is now trading near that 23,460 mark. So clearly, a lot of action and a lot of negativity is already being built into the Indian equity market. Yes, we have recovered from the lowest point of the day, but despite that, sitting with a cut of 0.8%, 23,465 thereabouts is where the Nifty is trading as we speak. But in terms of individual stocks, clearly several stocks continue to remain in focus. Let's talk about Gland Pharma. That counter reported its numbers for the fourth quarter. So we have Gland Pharma, which is up more than 12% on the back. In fact, it has now risen to 15%. That's the kind of gains that we are seeing for Gland Pharma. We have Somani Ceramics that is reacting to its results. Godrej Industries, Bajaj Electricals, Hind Rectifiers, a whole host of counters that are in focus, especially on the back of fourth quarter results that these companies have reported. Now remember, IT and pharma, these are the two pockets of the basket market that have been in focus for the last several trading sessions. We should have the Nifty IT index. This index is holding up in an otherwise weak market, and pharma continues to decline in today's trading session. We have Nifty Pharma, which is now sitting with a cut of 0.2%, but IT index is sitting with gains of more than 1% in trade today. So clearly, it's a stock-specific market, especially on the back of fourth quarter results. But we have several managements that are joining us on the show today on the back of their results and what the outlook is going forward. To discuss this, Kavita, we have the management of Medanta now joining us.
Absolutely. Look, let's just look at the numbers also. So good Q4 for Global Health as well as far as we can see the numbers coming up. Profit has definitely improved over here, although the margin has contracted a bit. But what we really want to focus on is where there will be any expansion going ahead. Also, liver transplant facility, is that going to be a reality soon? And what's the plan in store for that? Also, FY27 in terms of growth and expansion outlook will be in focus as far as the conversation is concerned. But look at revenue, it's almost 24.5% up, profit 46.6% up, and the number is at 145 crores, and the revenue is at 1159, EBITDA 8.5%. It's come up to almost 244 crores, but EBIT margin has come down over here. So this is a consolidated number that you can see as far as Q4 is concerned. But then let's get connected with the management also, and let's also understand what's going to be the further trajectory. We are joined by Pankaj Sahni, Group CEO Medanta, plus we also have Dr. Naresh Trehan, CMD Medanta. Hi, morning, and welcome both of you. Let's take this question first, and Pankaj, I'll come to you. So revenue is up 25% year on year, but margins have contracted to 21% versus 24.1%. Pankaj, what margin contraction solely attributable to higher employee expenses? Can we say that?
No, that is actually not correct. The margin contraction, which you look at on a consolidated basis, is largely linked to our very initial operating losses in our Noida facility, which really started its operations towards the end of November. If you look at our numbers, Q3 numbers had a little bit of a loss in Noida. That actually has reduced in Q4. So we have seen the peak losses in Noida, and we see that moving towards profitability towards probably the second half of this coming financial year. So all the losses that you are seeing in the margin contraction is really linked to the new operations in Noida. Ex-Noida, which is reported out in our investor presentation, you actually see a margin increase of about 50-70 basis points increase. And if you look at our performance, frankly speaking, even with the Noida losses across the full year, you will see that not only in the last year, but across the year, we've been growing both our revenue as well as our profitability approximately 20% consistently year on year. So the losses that you see and the margin contraction is really linked to the startup losses of Noida.
Right. Gentlemen, morning. Thank you so much for joining us. Ashesha this side. Since you already spoke about Noida, Mr. Trehan, let me come to you then. When do you expect this to break even? When do you expect this to turn profitable? Is it likely to happen in FY27 itself?
Yes, of course. If you're talking about Noida, I suppose. And Noida has actually ramped up very nicely now. The losses have been declining by the month. And we expect that by the middle of next year that we will have in this financial year, coming financial year, that we should be able to be cash positive in the next quarter or two. So we are very satisfied with the progress that is happening. We have a very high quality set of doctors as a team who are operating the place at a very high quality level. And because we just opened, it's beginning to show the footfalls, the patients, IBD, OPD. So it's all growing very nicely. So we expect turnaround in the next 3-4 months.
Pankaj, what proportion of insurance impanelments are still pending? If you can just shed some light on this.
Sure. In Noida, we've now received almost all the major empanelments. Any empanelments which are pending are a couple of smaller institutions. Almost all the major insurance empanelments have been received. In fact, we have also achieved our CGHS and empanelment in Noida as well. And we've also got our NABH quality accreditation within the first 6 months. It's a very short period of time. So we are well underway, both in terms of our insurance, our CGHS, our PSU, all our empanelments. And we don't see any real hindrance in terms of the growth on that unit.
And Mr. Sahni, what will the steady state EBITDA margin be for Noida that you're targeting over the next 2 to 3 years?
So that's always the million-dollar question. And as you may be aware, we don't give out any kind of margin guidance either for Noida or for the company as a whole. However, what I can say is that the performance of Noida has been very encouraging. We see no reason why there would be any change in the margin profile of Noida vis-a-vis some of our other units. The ARPOB trajectory has been very good. The growth has been very good. The performance of our operating clinicians there has been very strong. We have already 380 beds operational. We'll be adding in another 150 beds or so in the coming financial year. So as this scales up, we believe that it should not only be able to be delivering margins that are equivalent to what we see in the rest of the group, but actually on an overall basis, actually help to contribute towards the margin and profitability growth and EBITDA growth in the coming financial year.
Dr. Trehan, let's talk about high-value specialties, and within this, the liver transplant. When are you planning on this? What's the stage like, and what's the update?
So traditionally, what we normally do is to get all the foundation specialties actually well established. So it takes about 6 months from opening. So we are getting to that stage now, where very soon, in the next month or two, we shall do the transplant program. So there's always this methodology that we have used, and because the set of physicians that we have, the highest quality, you will see a lot of people are seeking us out for critical care. Like, in a way, you can say if you are not able to get the highest end of care across all specialties together, this is our main focus. Our actual construct is such that we have super specialists all on the same platform, and the patient is treated like it belongs to everybody, in the sense that whichever specialty is needed is right there. Not only there, but at the highest quality you'll ever find anywhere. So I think that with the teams performing the way they are performing, that it is just a matter of a month or two that we launch the liver and the kidney. Kidney's already been done, but liver, we will seek the approvals and then launch the program very soon.
So that's as far as the Noida market is concerned. But Mr. Sahni also wanted your thoughts on other mature hospitals, which includes Gurugram, Indore and Ranchi, where fourth quarter margins have improved to about 26.7%. And you have said that they're sustainable in that 24 to 25% range. What makes you this confident, and what could the downside risk be to this margin guidance that you have shared, which is in the range of 24 and 25%?
So when you look at the hospitals, and if you look specifically at our mature group, obviously it's dominated by our 1,500-bed facility in Gurgaon. And we have seen now consistently over the last several years, this performing very well, consistent growth through volumes, consistent growth through inpatient care, as well as seeing a good amount of growth despite some of the other hospitals that have come up in the region. So we see no reason for this to change. Keep in mind that when we report out our results, our corporate costs are fully loaded into our Gurgaon unit. So to that extent, analysts need to do some minor adjustments. But when we look at our performance, we see a lot of traction, a lot of excitement for new doctors to come in. We're actually adding in more operating room capabilities in our Gurgaon facility as well. And we'll continue to ramp up our clinicians in terms of recruitment here. So we see a lot of traction and a lot of demand for the kind of complex work Dr. Trehan was talking about in our Gurgaon facility. And when you look at this, of course, we don't run the company quarter to quarter, but when you look at this over the course of a full year, we see a very good trajectory, not only for our Gurgaon facility, but also for the other facilities. And even our Lucknow and Patna facilities now, they're also fairly mature. Lucknow has been operating for about 6.5 years, Patna for about 4.5 years. So we're seeing good traction in these and very high growth, even despite being operating for 5-6 years. So we feel fairly confident about the performance of the portfolio as a whole. We'll also be adding in, we've added almost 20% additional bed capacity this year. So about 600 beds have got added in our portfolio this year, which is not a small amount of beds. And we will be adding an additional 500 beds in the coming financial year. And all of those 500 beds will be coming in on brownfield capabilities. So with minimal capex investment in those additional 500 beds. So I think the next year, we will be consolidating on getting our existing portfolio up and running and operating smoothly, beefing up more clinical talent in our mature facilities, and also, of course, the 5 or 6 new hospitals that we have coming up in the next 3 to 5 years, get those up and running as well in Guwahati, recently announced in Varanasi, integrate the new acquisition in Indore, and get our Delhi and Mumbai facilities also up and running.
All right. So, Mr. Sani, again, coming back to the margins now, what is the long-term sustainable EBITDA margin for the consolidated business after all greenfield projects stabilize?
So again, like I said before, we don't really like to give too much conjecture on how the future will play out. Our focus has always been on putting our head down and focusing on delivering high quality work and letting the numbers speak for themselves. But if you look back in history and if you look back over the last 4 or 5 years, especially after COVID, you will find that Medanta has been one of those facilities and one of those organizations that has consistently delivered approximately a 20% CAGR on revenue as well as profitability year after year. We have a very, very good and well-balanced portfolio. So as we see new hospitals coming on board, they will ramp up to profitability. We have a lot of benefits of operating leverage given the size and scale of the facilities that we put into place. So as soon as the occupancy crosses a certain threshold, we see a disproportionate fall through to the bottom line. So we feel that, our margin portfolio, again, I've always maintained a kind of conservative portfolio in the range of 24 to 26%. But as you see operating leverage kick in, of course, there are benefits to EBITDA. But, over the next 3 to 5 years, there'll be a lot of excitement in the industry, a lot of growth in our organization. And we feel no reason why we can't see, this kind of margin profile continue to remain on a strong basis. Of course, like I said, our focus has been on driving high quality care, high complexity care. And if we keep our head down and focus on this, then, we see that the results will speak for themselves.
So margins are sustainable going forward, and you're very bullish when it comes to growth plans. And since we're talking about growth, we have to talk about expansion, isn't it? You have about 4,500 crores of capex that is lined up to add 2,700 beds over the next 3 to 4 years. How much of this 4,500 crore capex already committed? And Mr. Trehan, if you can share which geographies are currently under active consideration for this expansion.
So we are actually looking at the whole sort of geographies around us, but the basics right now, we are mainly in central India. We are in UP, Haryana, Bihar, Madhya Pradesh. So we are and Northeast, as we have already announced, and Mumbai that we have already announced. So we are always looking to expand. I don't think that we are able to announce any of the things that have not been signed up. So that's why we always want to respect the SEBI laws. But as you have quoted yourself, that we expect to add another 3,500 to 4,000 beds in the next 3 to 4 years.
All right. I think that will be all. Thank you so much, both of you, for being on the show and talking on the results today. Thanks.
Thank you.
Thank you.
Okay, let's move on and let's get connected with our guest on the show, Gaurang Shah Jugar Patel, our expert on the show, will be helping you on your stock-specific questions. Hi, morning, welcome both of you. And Gaurang, before I deep dive in our viewer queries and talk to you about the markets, let's just understand your view on global health. Any particular take after the results? Is it there under your coverage? I think you're on mute, Gaurang.
I'm so sorry about that, Kavita. Thank you so much for having me on the show. Good morning to you and to all your viewers. I'll give a disclosure first. All recommendations that I'll be sharing with you this morning on the show, Kavita, they're part of our fundamental research team recommendation. Our company, Jyojit, or myself, we do not have any kind of personal investments, no financial interest, no conflict of interest, but we share similar investment ideas with our clients. They might have their investment interest. So global health used to be under our coverage, if I'm not mistaken. And I think even the targets were in place. So currently we don't have a coverage. I won't go specific, but we like the sector, Kavita, healthcare. And within the healthcare, I think the entire hospitals, so starting with Apollo, Narayan Rudalaya, Fortis Healthcare, and Max Healthcare. These are some of the names that we are positive. And one thing that I personally feel, Kavita, this is my personal view, that this sector is relatively insulated from the external shocks in form of volatility in the crude oil prices and the kind of inflationary pressures that we are facing. We're positive, and I think the scope is very huge and as the management was speaking, Medanta, I think they've got good amount of capex lined up, not only with Medanta, but for other healthcare hospitals also have huge capex lined up.
All right. So, yeah, it's relatively insulated. But, Jugar, any stock-specific trajectory on global health would you want to recommend?
Very good morning, everyone. See, in terms of Medanta, currently we already had a run of 33% from the bottom of 960 approximately. And currently the stock is hovering near the 61.8% retracement of the entire fall from September 2025 till April 2026. So currently we are expecting a pullback at least till 1150, 1170, and that level would be a very lucrative for going long. As of now, it is wait and watch, and profit booking is advised.
Right, so that's the view coming in on global health. Medanta, the stock is sitting with a cut of 1%. But Jigar, also wanted your thoughts on the market. Nifty is now, of course, it has recovered from the lowest point of the day. But despite that, it is sitting with a cut of 0.7%. It is below that 23,500 mark. On the index level, what will your view be on the Nifty?
See, in terms of Nifty, currently we are, this is the second time when we are, taken support somewhere near 23,300 mark, and currently Nifty has made equal length, AB equal to CD kind of pattern on daily chart with bull divergence on hourly chart. So definitely 23,300 would be a very crucial support, and we are expecting at least a bounce back from this particular level. And overall, at least for next 2-3 days, we are expecting 23,600, 700 mark. And overall, the view will be buy on dips, and at current levels, definitely one should go for long and keeping a stop loss of below 23,300, and overall target would be 23,700.
So that's a take on the markets. But with that, it's time for a short break, and post that, let's get connected with our viewers and let's start answering the stock-specific questions. But before we slip into a short break, the WhatsApp number that's flashing on the screen, you can send across your stock-specific questions. Write on the name of the stock, the price at which you bought it, and the timeline till which you want to hold that counter. We'll see you after this break. Welcome back. You're watching Buy Now, Sell Now, and we are answering your stock-specific question. Jigar Patel and Gaurang Shah are guests on this show. And Jigar, I'll come to you. This is a question from Rima. She's from Chennai and she's holding 275 quantity of Hyundai Motors at 1925, and the time horizon is slightly long, 1+ years. She's also holding 255 shares of HDFC at 875 and wants to know if at this particular rate can she average it. We'll take a technical as well as fundamental view, but Jigar, I'll start with you.
See, in Hyundai Motors, currently the price action is definitely negative, but overall, if we look at the bigger picture, currently the stock is trading somewhere near between 78.6% retracement and 88.6% retracement. And overall, the momentum indicators are turning, losing steam on downside, and we are expecting a base creation and potential reversal somewhere between 1750 and 1800 mark. So currently, I would, suggest to add even more at this particular level and keeping a stop loss below 1650, and overall the target is expected till 2000. In terms of HDFC Bank, HDFC Bank currently has made double bottom structure with bull divergence, and there is a even previous support from 2024 April. So we are again bullish on HDFC Bank, and I would recommend to add even more at current levels, keeping a stop loss below 735 on daily closing basis, and overall bounce and target can be expected at least 830, 840.
Okay, Gaurang, your take on both of these counters?
Well, so firstly on HDFC Bank, Kavita, I think you got in at 875 if I read that right, and currently the stock is trading at about 760 odd. A fair amount of downside in terms of correction for long-term investors to add to the stock in case if they've gotten at higher levels. So, and again, from 750, sub 750 levels, Kavita, my view currently is that your downside is extremely protected. So hold on to your investment. Since you got in at high level, if you have investable amount, accordingly, you can invest from a long-term point of view. On Hyundai, Kavita, I think the entire auto sector looks quite positive, and we have coverage across the board: two-wheeler, three-wheeler, four-wheelers, commercial vehicle, pure EV plays, etc., etc. So instead of giving buy, sell, and hold for Hyundai, I must say this, that it is one of the strong competitors and strong player in the auto pack, and they have got a decent amount of lineup, especially from the EV portfolio, Kavita. I think there are some interesting plans to offer in terms of new launches.
Right, so that's the view coming in on the auto sector, Hyundai Motors, and apart from that, we also discussed HDFC Bank. But we have Deepak, who has written to us from Gandhinagar. He says that he's a long-term investor. He has about 350 shares of Afcons Infra at 435. He's asking whether he should continue holding on to this position, average out, or completely exit. Afcons Infra, a stock that has been in focus on the back of several order wins over the last few days. Gaurang, do you have a view on this counter?
So Ashisha, no specific coverage, but infrastructure is something that we are positive on. We have a couple of names under our coverage. I have no insight in terms of what are the recent news flows on the company specific. But when you invest in infrastructure related stocks, Ashisha, you need to have 2.5, 3 year plus kind of time horizon. And of course, at the same time, you need to keep a track about company's earnings as well. Won't be able to give specifics since we don't have coverage.
And Jigar, what will your view be on Afcons Infrastructure? A technical view on this counter. The stock, I believe, has been declining in trade today.
First of all, in Afcon, there is a definitely structure is bearish, and as of now, we saw brief bounce in the month of April, but again, the price action is turning negative, so there is no point in holding this particular stock. So I would advise to keep a stop loss below 300 on daily closing basis, and if it goes below 300, then definitely exit should be done.
Okay, let's move on and let's take the next question. This is from Sriram Raghuraman. He's also from Chennai. Right time to enter Lenskart. Jigar, come to you first.
Lenskart, again, there has been a very good correction from the top of 550 approximate levels, and currently the stock is holding the previous breakout zone. So definitely, based on hourly chart, there is a positive divergence visible. So I would recommend definitely one can hold at or buy at this particular level for target of 490, 495 odd levels, and stop loss would be below 455 on daily closing basis.
Stop loss below 455. Gaurang, trying my luck under your coverage. Lenskart.
No, Kavita, first of all, no, we do not cover it. We do not cover it even during the IPO time. And Kavita, the thing is, there is a lot of competition from the unorganized pack. Yes, I do agree that the company has been trying to do innovative things in terms of scalability for top line and bottom line. But the bad thing, like I said, there is tremendous amount of competition from the unorganized sector. Won't be able to give more comments than that because we don't have coverage.
Okay, so that's the view coming in on Lenskart. But let's put the spotlight on one counter which is in focus today, Amber Enterprises. This counter has reported inline set of fourth quarter results, but the management con call was very important. The stock has now declined 15%. Meryl is here to take us through what the management had to say in the con call. Meryl?
So yes, while Amber had reported quite an inline performance on financials, the management con call has been the key laggard on the stock. Now, in the con call, the management highlighted the few following factors which are seen to be pressuring the stock. One important one of these is the highlighted high commodity prices as well as the currency depreciation, which has seemed to be affecting the company's operational profitability. They've also outlined that the minimum wage revision, especially in the UP and Haryana states, pose as a major headwind for the company going forward for margins in its consumer as well as its electronics division. In addition to that, for the company's bare PCB businesses, the management has been seeing an increase in the input costs for copper-clad laminates, and this increase in raw material and input costs is expected to increase going forward. In fact, the margin compression has been highlighted for the full year FY27 at 50 to 100 basis points. That is the level of margin compression on a consolidated level that the company is penciling in for the full year going ahead. So these few factors on a broader level has been seeing pressuring the stock despite performing quite in line with the street's expectations. The growth outlook for the company is quite muted going forward.
So the growth outlook is muted, and that is the reason Amber Enterprises is now sitting with a cut of nearly 15% as we speak. But another counter which is under pressure today is Symphony. This stock is down almost 6.5 to 7%, 7.5% in fact now. And this is on the back of weak set of numbers as well as management commentary on demand, which was on the weaker side. But before that, let's talk about numbers. Revenue has declined 31% YOY. We have profitability. In fact, company has reported a loss this time around of 218 odd crores. So on the bottom line, it's a loss. Revenue numbers were muted. Operating deleverage weighed heavy on margins for the company in the fourth quarter, and one-offs impacted profitability, and that is the reason you see that loss figure on the bottom line. Margins at 14.8% that the company has reported this time around versus 22% that they reported same time last year. Now remember, one-offs, as I mentioned, impacted profitability. They wrote off 50 crore from a company, of which 45 crore is a one-off and 5 crore is irrecoverable. So there were several one-offs because of which the company has reported a loss on the bottom line. Now remember, fourth quarter FY25 was a high base year, because of which the numbers look muted in the fourth quarter of FY26. Revenue was impacted on account of channel inventory overhang, and favorable weather in south and west was yet to fully play out, and that is the reason demand was on the weaker side. In fact, management has said that demand remained under pressure in fourth quarter. So this line on the management commentary is very important. Demand was muted in the fourth quarter. Business is showing signs of improvement in April. So perhaps we could see some bit of recovery in the first quarter of FY27. But despite that, weak set of numbers, weak guidance, because of which the stock is down more than 7% as we speak.
Okay, so this was about Symphony, but then let's shift focus on Fusion Finance. So the numbers are looking in line. AUM has witnessed sequential recovery, though remained lower on a yearly basis. The stock right now is down almost 6.5%, but margins have improved sharply year-on-year basis, supported by higher lending yields. Asset quality has also improved meaningfully and declined in both gross and net NPA sequentially. Cost of borrowing has remained stable, which has also helped in margin expansion. And company is now also looking at focusing on portfolio quality improvement and profitability recovery. But then let's discuss more on this. We are joined by Sanjay Garyali, MD CEO of Fusion Finance. Sanjay, hi, morning, welcome to the show. Okay, let's just get a sum up from your lens. The Q4 numbers. How, according to you, will the trajectory be continued?
So I think first it's a very encouraging quarter four. And I think this was a result of whatever efforts that we did on the portfolio quality in the first 9 months of the year. And Q4 is actually a result of that. So this is the second sequential quarter that you see profit. While overall 114 crore of profit, but even if you remove the one-time DTA reversal of 77 crore, still the core profit or the core PAT is about 37 crore, which is a significant improvement over the previous quarters. And the ROA for the quarter is at 2%. Now, the most interesting thing or the most positive thing that we see from here is that the recovery in growth is here to stay. And we would want to reconfirm that the 10,000 crore guidance that we have given for next year is absolutely on target. In fact, April and May, first 2 months of this year, already about 50 days have gone by. The performance is bang on plan, whatever we had planned for this year from an AOP perspective. Along with that, the portfolio quality continues to be pristine because it is very important that while we are growing, the portfolio remains pristine. That continues to be from a collection efficiency perspective at about 99.8, 99.9. So we are fairly confident on growth going forward in a very calibrated manner, and the portfolio quality will continue to be pristine.
So you're confident on growth going forward, Mr. Garyali. Morning after Sheshat aside, how do you plan to scale your MSME portfolio while maintaining your asset quality? What will your MSME portfolio expansion and growth plan be?
Yeah, hi, Shesha. So very important, MSME gives us that diversification place. So if you see, when we started the year, we were at about 6 to 7% of the portfolio was MSME. Now we are at about 11%. The guidance that we have given is at 10,000 crore book at the end of this year will be about 15% MSME. Now the MSME that we do is in tier 3, tier 4 markets. Our customers are MSME. Essentially, the sweet spot or the right to win that we are creating is between the 8 to 15 lakh ticket size. Most of the income assessment that the origination that we do is in the income assessment programs. And that is the strength that we have developed over the last 1.5 years. We have two channels, the direct channel and indirect or the connector channel. About 65% of the business comes through our own executives, where we have seen a significant improvement on productivities. So quarter four was roughly about 45 crore of monthly disbursement on MSME. This we will see growing from here on. And the portfolio, while it is early vintage, the portfolio or the early bucket efficiencies of MSME also continues to be upwards of 99.3%. So we are confident that MSME, the way we are creating a right to win, will be about 15% of the overall AUM by end of this year.
Also, are current collection efficiency levels sustainable across geographies and borrower segments?
Absolutely. So in November 25, the exercise that we took was that instead of a state level, we built or we took everything at a branch level. So there are 4 categorization that we have divided all the branches. 90% of our disbursements happens from Cat A and Cat B branches. So while every state or the top 4 states where most of our books are, the collection efficiency is upwards of 99.75 and is definitely sustainable. And we are seeing the same in April and May. However, there are certain pockets in C&D branches which automatically, as a part of the credit metric or credit filter, get filtered out. And there is hardly any disbursements that are, or as a percentage, the disbursements are very calibrated in those branches. That's why you see the weighted collection efficiencies continuing to be upwards of 99.8, and they are definitely sustainable.
How do you see credit costs normalizing going forward? How are SMA1 and SMA2 buckets trending? And how has portfolio stress stabilized fully in the fourth quarter?
Yeah, absolutely. I think if you see, it's almost shrunk. It's 2 has come down to what, about roughly 60 crores on a book of 7,500 crore. It is almost irrelevant or insignificant. I think that's as we say, it will continue to be like that because the flows from the early buckets are almost zero. The net flows from the early buckets are 0.1%. If you do a back of the envelope calculation, hardly about 5 crore or 6 crore will move in a month. That's about 15 crores in a quarter at that book. So we continue, and while the book is growing at about 15-20% quarter on quarter. So on SMA2 and on the overall GNPA, you will see continuous reduction happening on a sequential basis. From a credit cost perspective, I think we are looking at a model of somewhere around 2.5%, which will mean a GNPA of what, close to about 2.9 to 3%.
Okay, moving on, what are the sustainable medium-term ROA and ROE targets for the business now?
Okay. So we have given a guidance on credit costs and we have given a guidance on the overall book growth, which is, let's say, 10,000 crore. We don't give annual guidances on ROA or ROE, but on a stable level, so which technically should happen in, let's say, 1.5 to 2 years' time, this business will be somewhere around 3.75% ROA, 2.5% credit cost, and between 20 to 25% CAGR growth.
Right. And what are the latest trends in recovery, slippages, and overall portfolio? What are the trends that you're seeing across these segments?
So we have continuously seeing improvement in the current bucket customers, and essentially it is happening because the customers that we have acquired, the assessment is far superior than what we used to do. Let's say the industry used to do about a year and a half back. So that will continue to improve. Also in the buckets that we have written off, if you look at the write back recovery, so there is 2,000 crore of write off that we did in the last 1.5 years when we were going through a stressful time. It's not that we are leaving that book. There is this quarter also you seeing about 21 crore of recovery in that write-off book, which is a significant upside, about 40-50% growth over the previous quarter. Other than that, there's a recovery of another about 15 crores happening from the 90 plus book. So overall, about 36 to 38 crore of recovery in the entire 90 plus and the write-off book in the hard bucket, and very strong performance in the early bucket collections. So that's a trend we see going forward from here.
All right, I think with that, it's time on the show. Thank you so much for taking time out, Sanjay, and answering all the questions. Thank you.
Yeah, thank you so much, Ashish and Kavita.
Okay, let's move on. And Jigar, I would like to know your coverage on the charts on Fusion Fashion, if at all you have any recommendations.
See, in terms of Fusion Finance, currently, if you look at the chart, after a massive fall from 655 till the bottom of 130 approximately, since last 8 to 10 months, there has been a massive consolidation in the zone of 145 till approximate 210 zone. There was an attempt of breakout, I think, a couple of weeks back, but overall the breakout has failed. So as of now, the chart is again showing some sideways direction, but this particular counter should be kept on radar because a close above 225 can lead the counter till at least 300 mark. So as of now, wait and watch. A close above 225 will trigger a fresh buying, and in that particular case, the target would be somewhere near 300, and the stop loss would be placed below 200 on daily closing basis.
Okay, so that's the technical view coming in on Fusion Microfinance. But on that note, we need to slip into a very short break. We'll address many more viewer queries. Keep sending them to us. We'll be back in a jiffy. Welcome back. You're still tuned in to Buy Now, Sell Now right here on ET Now. And let's now put the spotlight on ICICI Prudential Life. The stock is lagging in trade on the back of Bharti deal. The partnership aims to expand access to life and health insurance protection solutions across India. And Darshita is now joining us with more details on this deal. Darshita?
Well, yes, Bharti Enterprises and Prudential PLC have announced a major insurance deal with Prudential acquiring a 75% stake in Bharti Life Insurance for about 4,200 crores. Now, this deal includes an upfront cash payment of 3,500 crores with an additional of 700 crores to be paid subject to certain conditions. The transaction value of Bharti Life Insurance is at around 5,600 crores. Now, this partnership combines Prudential's global insurance expertise with Bharti Enterprises' India presence and is expected to strengthen Bharti's life product offerings and distribution across broker, agents and direct channels. The company are also betting on India's low insurance penetration and rising digital adoption for future growth. However, this development is seen negative for ICICI Prudential Life. Now, Prudential PLC currently owns 22 to 23% stake in ICICI Prudential Life, and as per the regulatory norms, this stake may have to be reduced below 10% after Bharti Life acquisition. Now, Prudential stake in ICICI Prudential Life is estimated to be worth around 17,800 crores, and the possibility of a future stake dilution or the exit is the key overhang for the stock. Meanwhile, Bharti Life Insurance remained loss-making in FY26, reporting a loss of 74.32 crores versus a loss of 36.8 crores in FY25.
Right. Also, it was a steady Q4 for Vodafone Idea. The telecom company swings to profit at on one-time accounting gain from AGR reassessment. Darshita, give us more details on this, please.
Well, yes, Vodafone Idea has reported its Q4 FY26 numbers and the performance was operationally in line. Starting off with the headline numbers, revenue came in at 11,332 crores, which was flat sequentially, while the EBITDA rose to 4,889 crores, with the margins seeing an uptick of 34 basis points coming in at 43.1%. And the customer ARPU has also improved to 190 from 186 in the previous quarter. Now, the biggest highlight for this quarter was the uptick in the PAT. So, Vodafone Idea reported PAT of about 51,970 crores versus a loss of 5,286 crore last quarter. Now, this was driven by a one-time exceptional gain of 57,491 crores after the Department of Telecommunication finalized the AGR dues at rupees 64,046 crores versus 87,000 crores earlier. Another key development to focus on is the fresh fundraise announcement by the company. The board approved the issuance of 430 crore warrants worth rupees 4,730 crores to Suryaja Investments, which is an Aditya Birla Group entity, also at rupees 11 per warrant. Now, post-conversion, this entity is expected to hold around 3.82% stake in Vodafone Idea. Operationally, the company continued to see signs of recovery with customer base at 192.8 million and the continued 4G, 5G rollout, with FY26 capex at around 8,742 crores. Focusing on the brokerages, Citi maintained a buy rating for the target price of 14 per share, saying AGR reassessment and promoter infusion are early signs of operational recovery, while also improving the funding visibility and the capex for the future prospects.
All right, Darshita, thank you so much for all those details and stock-specific news. But then let's move on. Let's get connected with our live viewers. We have Ghosh Dada from Delhi on the phone line. Good morning. How are you, Ghosh Dada?
Fine, thank you. Absolutely fine. I'm excited to talk to Gaurang.
Great. You can ask your question. He can hear you.
Gaurang, as you know that, I know you and I always respect your view. And I keep on waiting for Monday so that I can see you and ask you questions. But these people don't take my question. Last time also I asked you questions. I never got it. My question to you today is, I have bought for the Vodafone. I'm having around 50,000 shares of Vodafone at the rate of 11 rupees 25 paisa. I have all the news, the government, what is their policy. Those things I read. My question to you is simple. Should I buy another 50,000 shares? I can take risk at the age of 77, not a problem at all. If you tell me yes, I'll just buy it, today only. So your view is very, very important to me.
All right. Thank you so much, Dada. Yeah, Gaurang. Yeah, continue. Yeah, please.
I'm sorry, I'm intruding, I'm crossing in, Kavita, but his words were so pleasing. So thank you so much, Ghosh Dada, for all the kind words. It's always encouraging to listen into these kind of words. And we'll try to take as much as questions and queries possible in the show. I'm sure Kavita, Ashisha, and our team are doing just fine in terms of doing that. To answer your question, first of all, Ghosh Dada, at 76, you taking risk is something that I will not advise. So that's my first advice to you. Though you have a risk appetite, but I think it's not necessary to jump into the fire when you know there is better place to be in, Ghosh Dada. So first of all, we have a neutral stance, Ghosh Dada. So in neutral stance, I can't give you buy, sell, or hold. We have a neutral stance. That means we don't expect the stock to do much either ways, on the upside or on the downside. As far as the reaction to the stock is concerned today, I think this one-off gains that has translated into positivities, it would be more important for me to see the company coming in black and then in the green by the virtue of the operations improving and their efficiencies improving and their margins improving, which is not the case because ARPUs, Kavita, correct me if I'm wrong, for Vodafone India, the ARPUs are much on the third stage. Bharti and Jio have better ARPUs. That means they need to scale up the ARPUs, which looks a little bit difficult. Ghosh Dada, the debt on the balance sheet also quite heavy. Though the good news is that they have stopped or they have reduced the amount of customer base that they were losing month on month. It will be important to see how Vodafone Idea scales up in terms of technology also because of 4G, 5G, and of course the next gen communication platform that we'll be witnessing. AGR dues need to be paid in installment. So how are they going to recover that? And from where are they going to make those payments? So there are a lot of red flags, Ghosh Dada. And because of the regulation, on a neutral stance, I can't give you either ways opinions. I will only request you to be careful and cautious.
Okay, and since we are talking about Vodafone Idea, Gaurang, what will your view be on Bharti Airtel? You were just talking about ARPUs and how for Vodafone Idea it is lower as compared to other listed players. Your thoughts on Bharti Airtel?
So let me give a step further answer, Ashisha. We have a positive coverage on Bharti Airtel and we have a positive coverage on Reliance Industries. Now, we all know Reliance Industries has got diversified businesses. Geo Mobility is one of them, and there is also a lot of expectation on the street that possibly this year, second half, you might see Geo Mobility being hived off and listed as a separate entity like Geo Finance. But we'll have to wait and watch. We'll let the management take a call on it, but we are positive on both.
All right, so that's the take coming in on both of these counters. But let's move on. Let's talk about Cochin Shipyard. Cochin Shipyard is down and out on weak set of earnings. But what are the factors that are ailing the company? Karan, our colleague, joins in with more details. Karan, take it away.
Well, Cochin Shipyard is under immense pressure in today's trade on the back of its Q4 earnings. The company has missed its annual top-line growth guidance and reported a 4% growth versus the guidance of 10 to 12% growth. While the revenue is down 16% at 1,400 crores, the EBITDA is up 17% at 300 crores. Moreover, the reported profit is down 4% and stood at 276 crores. The EBITDA margins were at 20.8% level. Now, one may wonder why is the EBITDA up despite the decline in revenue. This is on account of two factors. The first one is the reversal of provisions to the tune of 21 crores. And the second reason is the significant 29% reduction in the subcontracting expenses. The raw material cost as a percentage of revenue, which stood at 40% in Q4 last year, has increased to 48% in Q4 of this year. On that note, do watch out for Cochin Shipyard.
Karan, stay on with us. Another counter from your sector, which is in focus, is Power Grid. The company has reported fourth quarter numbers, but the company missed estimates. Revenue and EBITDA also came under pressure. Take us through what Power Grid numbers look like and what brokerages have to say on this counter now.
Well, yes, Power Grid from the Nifty pack is out with its Q4 earnings, wherein the revenue and EBITDA has missed the street estimates. However, the profit after tax is largely in line with the street expectations. The profit is largely in line with the street estimates, considering the deferred tax implications and a higher net movement in regulatory deferral account balances. While the revenue was down 5% year-on-year and stood at 11,600 crores, the EBITDA is down 11% and stood at 9,000 crores. There is a significant contraction in EBITDA margins as well, and it appears that the Q4 EBITDA margins are at a 13-quarter low level. Diving deeper into the business segment, the transmission segment reported a revenue of 10,800 crores. Moreover, the board of directors have approved raising of funds to the tune of 5,000 crores. Remember, the company had shared the following updates in March 2026, whereas on the capex front, the company had already achieved 35,500 crores, and on the capitalization front, the company had already achieved 22,700 crores. Moreover, the company has a planned capex for FY28 to the tune of 82,000 crores. The company has also stated that the power demand in India is expected to more than double by 2047, and the company is looking at 786 gigawatt of renewable capacity target by 2036. Over to you.
Right, thank you so much, Karan, for all those details. But then on to a breaking news. Jana SFB is in focus today as the board approves fundraising. Ankur Mishra, colleague, is there on the phone line to give us more details on this. Ankur, what's the news and what's the update?
Yes, sources close to the development have informed that Jana Small Finance Bank held a board meeting today, and in that meeting, which is likely to be continuing, has approved the fundraising plan. Now, more importantly, TVS Group is likely to invest up to 9.99% stake in Jana Small Finance Bank, and this is as per the regulatory ceiling. We know that up to 10% it is allowed, and subject to Reserve Bank of India approvals, the fundraising have been approved through TVS Group and others. The total fundraising could be around 600 to 700 crore, but we understand that the TVS Group is likely to invest up to 10%, which is exactly 9.99%, which is likely to be in the range of 400 to 450 crore. We are waiting for the board meeting to get over soon, and we may see the announcement by Jana Small Finance Bank for the fundraising is likely to happen anytime now.
You're expecting the announcement anytime soon. That's the word coming in. This is with respect to fundraise for Jana Small Finance Bank. Ankur, thanks so much for joining us with all those details. So this is a report from our sources which suggests that perhaps the board could be considering fundraise, and the outcome of which is expected in just a few minutes. But let's also take a look at what the market is doing at this point in time. And yes, we have recovered from the lowest point of the day with Nifty now at that 23,500 mark. We have Nifty Bank, that one continues to underperform, 1.2% lower, 53,050 thereabouts is where the Nifty is now trading. In terms of individual sectors, we have auto index which continues to bleed. We have defense stocks which continue to remain under pressure. In fact, Nifty defense index is now down more than 2% in today's trading session. IT, that's the only index which is trading with some amount of gains, but otherwise all sectoral indices continue to trade with some amount of losses. Cochin Shipyard down 6%. We have Garden Reach Shipbuilders, MTAR Tech, Zentech, Mishra Dhatu. All of these stocks from the defense sector continue to remain under pressure, down more than 4% in today's trading session. But that's all the time we have in this edition of the show. Thanks so much for tuning in. More news and updates will continue on the other side.